If you're an investor in Australia, it is more than likely that you're receiving franking credits. But if you're not sure what a franking credit is, stick around because I'm going to explain exactly what they are and why they're beneficial to you. Hey guys, my name is Michael and I'm an accountant from Australia. On this channel, we talk all things money and finances so that we can all reach financial independence together. Now, if you own any shares in Australia, it is really likely that you receive dividends, and with those dividends come franking credits. So in this video, I thought it'd be really helpful if we talk all about franking credits, what they are and what they do. But first, we need to talk about dividends. Being a shareholder entitles you to a portion of the company's profits, and these will usually be distributed to you in the form of a dividend. Franking credits, also known as imputation credits, were introduced in 1985 to prevent the double taxation of individual shareholders on receiving the income from companies that have already paid tax. In Australia, there are two types of dividends that you need to worry about for taxes. First of all, we have franked dividends, and second, we have unfranked dividends. Franked dividends are dividends that are paid from Australian companies to you, and they're paid out of profits that have already been taxed. A dividend that carries tax credits for the entire amount of the dividend is known as a fully franked dividend, whereas unfranked dividends are dividends that are paid that have not had any tax paid on them at all. Let's think about an example. You are a 100% shareholder of an Australian company, and this company made $100,000 profit. This company is going to pay tax on those profits at 30%, which means they pay $30,000 tax. The remaining $70,000 is going to retain within the company and may be distributed to the shareholders at their discretion. Let's just say that this company has decided to distribute 100% of the profits this year as a franked dividend. That means that the remaining $70,000 will be paid to you, and attached to that $70,000 will be $30,000 tax credits in the form of franking credits. When you then go to lodge your tax return, you will say that you received a $100,000 dividend, which counts for the franked portion and the franking credits. And assuming you have no other income or expenses, and you'll pay tax on that $100,000. That tax equals $22,967. However, you need to consider the $30,000 franking credit that you received as a part of your dividend. So you would take that $22,967, subtract the $30,000 franking credit that you received, which means you should be expecting a tax refund of $7,033. See, this is the beautiful thing about franking credits. The company has already paid the tax, so you're not expected to be hit with the bill. And if you're in a marginal tax rate that's lower than the corporate tax rate being 30%, you should be expecting a refund every year. You're in a really tax efficient environment. However, if you're in a marginal tax bracket above the corporate tax rate, say the highest rate of 45%, you'll just have to pay a little top-up tax of the 15% difference between your tax bracket and the company tax bracket. So now that we understand dividends and franking credits, I just wanted to give you a couple of tips to make sure that you are the most efficient when it comes to your dividend investing. The first tip is to make sure you quote your tax file number to any companies that you receive dividends from. If you don't do this, on any unfranked dividends that you may receive, the company is required to withhold 47% tax, which you will eventually get back on your tax return, but just to save the hassle, just quote your tax file number up front and you'll receive the unfranked dividend in full. The second tip comes down to the timing of when you have to assess your dividends in your tax return. A lot of times shareholders get confused when companies say that they pay their final dividend for the 2021 financial year. However, they don't actually pay the dividend until July or August 2021. According to the tax law, dividends are assessable when they're actually paid. So when you receive the cash in July or August is when you have to pay the tax on them. So in this instance, you'll be paying the tax in your 2022 tax return, not your 2021 tax return. The third tip that I have is if you hold any shares in a joint name, such as with your partner, you're not required to lodge a partnership tax return. You just need to include your proportion of the dividends and franking credits received in your own tax return. And my final tip is, now that you understand how franking credits work, when you're looking to invest in shares, why not just take a look at how they frank their dividends? If you're choosing between company A and company B, and if company A pays fully franked dividends and company B doesn't, you may be better off doing company A because you get better tax benefits when it comes to the end of the year. However, there is one pitfall you need to look out for, which is called the 45-day holding rule. And what this rule means is that you have to be holding a share at risk for 45 days before the dividend announcement date to be entitled to that dividend. So you can't just think you can buy a share the day before that company announces its dividend. You won't be entitled to that dividend when they actually pay it. However, there is one exemption to this rule. if you're what's known as a small shareholder, meaning that you're entitled to less than $5,000 franking credits during the year, that you may actually be entitled to those dividends and franking credits. One other quick piece of advice, if you are on a dividend reinvestment plan, just because you didn't actually receive any cash, you still need to pay tax on the dividends, but you still get entitled to those franking credits. So if you are automatically reinvesting your shares, just because you didn't receive payment in cash, you still pay tax on the income that you received. So just keep that in mind when it comes to tax time. Thank you so much for watching, guys. If you enjoyed this video, please consider subscribing. I have tons of videos on my channel about taxes, personal finance, and investing. So if that's up your alley, I'd love if you could stick around and watch some more.